Welcome back, students. So now let's continue from previous video. Remember, in the previous video we were able to show how we're going to adjust for the fair value adjustments, whereby we added to equipment and we established a fair value reserve. Now the equipment resulted into additional depreciation, which we prorated, and we got 120 million, and which we have adjusted appropriately. So we want to move on to the next additional information, and that will be additional information 5. Oh, let me see. Yes, additional information 5. Okay. The additional information 5 states that the 60% of share capital of Famous that was acquired was settled through a share exchange. It was settled through a share exchange. What they are saying there is that when unitarization acquired 60% holding in Famous, ordinarily, unitarization PLC should pay cash to Famous PLC as purchase consideration. However, unitarization PLC has the option of paying in other modes other than through cash. In this case, what he has done is a true share exchange payment. That is, he says, Famous, as it is right now, I'm cash trapped. As it is right now, I don't have too much cash on me. I'm not so liquid. But you know, my company is a very good company, and my market price is very valuable on the stock market. I'm sure that is what he must have been telling Famous. Now, my market price is very valuable on the stock market. Now, instead of giving you cash, why don't I just give you some shares in my company so that you can also become a shareholder in my company? So, unitarization PLC is giving Famous some of its own shares. It's giving him his shares to acquire the shares in Famous. So, that is a situation of a share exchange. Unitarization is giving its own shares to Famous to acquire shares in Famous. Share exchange. And whenever there is a share exchange in a question, whenever the purchase consideration is through a share exchange, they will always give you the terms of the issue. And they gave us in this question. And they said the terms of the issue is that unitarization PLC will give 2 shares in his own company for 3 shares in Famous. These 3 shares in Famous could be very confusing. What they mean there is that for 3 shares, unitarization has acquired in Famous. And of course, they must give you the market value of unitarization and the date of acquisition at 6 naira per share. Now, let's go and adjust for this purchase consideration that was made through share exchange, and that will be workings what? That should be workings 5. So workings 5. Purchase consideration. And this purchase consideration was done through a share exchange. And this share exchange were given the terms of the issue that unitarization will give 2 shares. 2 shares in its own company for every 3 shares. For every what? For every 3 shares he has acquired in Famous PLC, and he acquired 60% of the total shares in Famous. So we need to determine the total shares in Famous PLC, and that you will get from the statement of financial position. So let's go on straight to the statement of financial position to know the number of shares Famous has. And this is it, the equity shares. This is the value of the shares, 2,400. This is the nominal value. To get the number of shares is simply 2,400 all upon the nominal value, which is 1. So the total number of shares is 2,400 shares. Note that if this one were to be 0.5, it will have been 2,400 divided by 0.5. I'm sure you're getting me. Having determined that, then immediately we want to go and determine what we're working on. So since we know that the number of shares is 2,400 shares, so 2,400 shares. Remember that all these are in millions. I'm sure you remember. Okay, so bring out your calculator, please, so that we can get the number of shares issued to Famous PLC by Unitarization PLC. So the number of shares issued will be 2 all upon 3 multiplied by 0.6 multiplied by 2,400, and that gives me 960 million. Okay, 960 million shares. That is the number of shares issued by Unitarization to Famous. What we need in reporting is not the number of shares. What we need is the monetary value. So we need to determine the value of these shares. So what's the value of the share issued? Which will be the number of shares issued multiplied by the share price of the issuer, which in the question we were given as 6 naira. If you remember, they gave us as 6 naira. Okay? So multiply by 6 naira. Though, using your calculator, multiply 960 by 6. That will give you 5,760 million. And this is the value of the share issued to Famous PLC. With this value of the shares issued, because this value of shares issued represents an investment that was made by Unitarization PLC in Famous PLC. Therefore, it will debit an investment in subsidiary by an addition to investment in subsidiary account with 5,760,000, 5 billion in this case. Okay, let's just leave it as 5,760. Since it's issuing shares, so share capital will increase. So it will credit share capital account, which is an addition to share capital. Any amount that is added to share capital must be added at the nominal value. Therefore, what you add to share capital will be the number of shares, which is 960 shares, multiplied by the nominal value of unitarization, which is 1 naira. Let's go and confirm that from the statement of financial position. You will be given that in the statement of financial position of unitarization. 1 naira. Okay? This is 1 naira here. Now, so what will that give us? That will give me 960 in naira. The excess amount over the nominal value will be added to the share premium by a credit to the share premium account. So we'll put it as an addition to where? To the share premium, which is the 960 shares multiplied by the premium, which is 5 naira, the 6 naira minus 1 naira. And what does that give us? Using your calculator, if you do 960 multiplied by 5, that gives me 4,800. The addition of these two must give you 5,760. You can confirm it if you want. It gives you 5,760. So this is how you adjust for purchase consideration when there is a share exchange. So we have adjusted for that. So what we have done invariably is that We have determined an investment in subsidiary that will be cancelled out on consolidation. And there is an addition to share capital through the issue of shares, which resulted in an addition to share premium also. And these amounts must be adjusted appropriately on consolidation. So let's move on to the next additional information. And we are moving on straight to additional information 6. And additional information 6 says that in the post-acquisition period, Unitarization PLC bought goods from Famous PLC amounting to 4,800,000,000. And Famous PLC had made a markup on cost at 40% on the transaction. And it says, as at the end, Unitarization PLC had sold part of these goods worth how much? 3,120,000,000. Now, this is just a scenario where there is an intragroup sales of goods, where there is a transaction between the parent and the subsidiary. So let's go and adjust for these intragroup sales of goods. So move on to the next additional information, and that will be additional information 6. So additional information 6. There was an intragroup sales of goods. Intragroup sales of what? Of goods. And this intragroup sales of goods, who sold to who? Can't remember. I need to go back to the question. Who sold to who? Okay. Famous sold to Unitarization because Unitarization bought from Famous and the sales price was 4,800 or 4,800,000,000. Okay. Alright. So Famous, who is the subsidiary? It was one that sold to Unitarization. Famous sold to Unitarization. And he sold at a selling price of, if my level of rounding off is million, then that will be 4,800. And with this 4,800, in the statement of profit or loss, because it is an intragroup sales, you are going to deduct it from the sales of the selling entity. You will deduct it from the cost of sales of the buying entity. And finally, the selling entity will have made a profit, especially a profit on unsold item. And this unrealized profit must also be eliminated. Therefore, any unrealized profit, we are going to eliminate it. So you deduct the unrealized profits. However, you deduct it through an addition to your cost of sales. Okay? You add it to your cost of sales because when you increase your cost of sales, you are deducting or you are reducing your profit. So you eliminate it from an addition in the cost of sales. However, in the statement of financial position, what you eliminate is the unrealized profit. Therefore, we need to determine the unrealized profit. And the unrealized profit is determined as this. And the unrealized profit, they said, the selling entity marks up its goods by 40%. So we're given a markup of how many percent? Of 40%. However, this markup cannot be applied on sales because markup is a profit that is expressed as a percentage of cost. So markup is applied on cost. What you apply on sales is margin. Therefore, this markup that was given in the question of 40% needs to be converted to margin. And for you to convert it to margin, it will simply be 40% all upon 100. Then you add the 40%. Okay? You add the 40%. So it becomes 40 over 140. Then that is what you are going to apply on the unsold inventory, which will be the amount sold to unitarization minus what has been sold out. What has been what? What has been sold out. I want to get that information from the correction. That unitarization PLC had sold part of this goods worth 3,120,000,000. So he has sold 3,120. So let me get that. 3,120,000,000. So what you are going to have left here is the unsold inventory. Because the unrealized profits is usually determined on the unsold goods. The goods that remain within the inventory. If this entire goods has been sold out by unitarization, this 4,800 has been sold out. That means the unrealized profit has become realized because it has been sold out of the group. It is unrealized because the goods are still within the group. And what is within the group is 4,800 minus what has been sold out. That gives us 1,680. And that 1,680 is what you apply this margin on, which is 40 over 140. So I multiply by 40, then I divide 140, and that gives me an unrealized profit of 480 million. So my unrealized profit is 480 million. That's the unrealized profit. So how do you eliminate this unrealized profit in the statement of financial position? To eliminate this unrealized profit, because it will have been added to the profit of the selling entity, which will flow directly to the consolidated retained earnings or the retained earnings of the selling entity. Therefore, we're going to deduct it by a debit to retained earnings of the selling entity. And the selling entity in this case is Famous. So we deduct it from the retained earnings of Famous, the 480. And also it will appear in the inventory of the buying entity. So we're going to remove it from the inventory of the buying entity. So you deduct it from inventory also. And that is how you eliminate the unrealized profit in this consolidated statement of financial position. So this is how you deal with intra-group sales of goods in the statement of profit or loss and in the statement of financial position. Please remember that. So now let's go on to the next details in the correction, which is like the final information. Additional information 7. We were told that Famous PLC's trade receivables at 31st October 2014 includes 360 million due from Unitarization PLC. However, the amount did not agree with the corresponding balance in the Unitarization PLC's trade payables ledger. So there is a difference. Famous has a trade receivables that Unitarization you are owing me. And you are owing me 360 million. But Unitarization is saying that, come, my trade payables is saying that I'm not owing you 360 million. I'm owing you an amount lesser than 360 million. You see, ordinarily they should be the same. Trade receivables and trade payables should be the same. Because what I say you are owing me in my books is what you have as a trade payables in your books. It has to be the same amount. However, they are not the same in this case. There are usually two situations that can lead to this. The first is either there is a goods in transit or there is a cash in transit. In this case, the question already gave us in note 2. So you need to be very careful. They gave us in note 2 here that there is a cash in transit of 120 million that is due from Unitarization to Famous. So what has happened here is that Unitarization has actually sent some money to Famous PLC, but Famous PLC has not received that money. That is why Famous PLC is still having 360 million. While Unitarization PLC is having another amount which is lower than this 360 million. So let's reconcile it. How do we do that? So it's also arising from intragroup sales, and that will be additional note 7. So additional note 7, which arise from intragroup sales. So in this additional note 7, we have unitarization and we have Famous. Unitarization will have an amount, non-unitarization, Famous. Famous says he has a trade receivables of 360 million. But unitarization is having something different. Why? Because there was a cash in transit. There was a cash in transit of 120 million. So what trade payables unitarization will be having will be this 360 minus 120, which is 240. That's what he was having, because he has sent 120. So how do we do this? For a fact, intragroup transaction must be eliminated. So the trade receivables, we are going to eliminate it. The trade payables will eliminate it. And we're going to consolidate the cash in transit. So to do that, you eliminate the trade receivables by a credit to the trade receivables account with 360 million. We eliminate the trade payables by a debit to the trade payables, which is 240 million. And we are going to consolidate the cash in transit, which is 120 million. So this is how we adjust for the intragroup transaction. So let's go back to our workings. Okay, so we are through with working 7. So now we are moving on to workings 8, which says that we should assume that profits or losses accrue evenly over the period, except otherwise stated, which we have explained this already. So profits or losses accrue evenly over the period. And this particular point is always given in a question where there is an acquisition during the period. In this case, you will see that it is an acquisition during the year, which means that all statements of profit or loss items must be prorated on time proportion basis unless otherwise stated by the examiner. And that is what this is talking about. So we have looked through and dissected internally all the requirements of this question. We have looked through everything and we have extracted the important points. However, the next phase is for us to now determine the goodwill or the gain or bargain purchase by a cancellation of the purchase consideration with the equity of the subsidiary. And also we need to determine the consolidated retained earnings, and also we need to determine the non-controlling interest. But before we can determine all that, we must first of all determine the pre-acquisition reserves. And we're going to determine that in the next video. Feel free to watch this video over and over again. And I'm sure you know that you can ask questions and interact with your lecturers. You can interact with me from our website on www.nomba.ng. In there, you will see a lot of resources that you need that will help you to pass your ICAN exams. So thank you very much, guys. See you in the next video.